Today we'll be talking about Marcellus and Haynesville inventory. It's a hot topic. We see an increased demand for gas in general in the United States and the world, and so we think that it is timely to talk about these two basins and the work that we do here at Novi. For this presentation, we have Robert Polk. He is a Director of Corporate Research at Novi Labs. Prior to being part of the Novi team, he worked as a principal for Wood Mackenzie for multiple years, and prior to that, in multiple other opportunities in banks. And so a few things for everybody to know is that we want to give at the end of this presentation time for you to ask questions. So as you have a question, you can put it in the chat, but we will try to leave, question and answers for the end. And additionally, as I said, I put in the chat of this webinar a link for you to register to our intelligence product. We have a free tier so that you can access multiple papers of Novi and some of the slides of today's presentation. And for those that have already a subscription, basically you have full access to this inventory analysis and reports. And with that, let me pass it to Robert, please.
Okay. Thank you, Jorge, and thank you everyone for joining this afternoon. So we did a webinar last fall called Permian Staying Power, where we kind of went through the intelligence views in our inventory product for the Midland and Delaware basins. And so what we wanted to do with this one today was do kind of a similar style webinar and share our views and our research, assessing gas inventory across, the two predominant gas plays in the U.S., Haynesville and Marcellus. It's especially topical now because, there's kind of general consensus, long-term positive demand growth for natural gas, and certainly U.S. gas is going to play a role. It's especially pertinent now given, kind of the turmoil and disruptions that are going on in the Middle East. And so it just kind of continues to shine a spotlight on, the resource that we have here domestically and both, kind of the reliability, affordability, security of supply that, these U.S. gas basins provide for us and their impact, kind of in the world. I want to be clear up front. So we will be sharing our inventory thoughts. This is not a robust, supply and demand outlook. It's just more of a belief, kind of directionally we see growing demand and we want to assess the inventory that's certainly going to play a role in filling the supply that meets that demand growth. We'll be sharing views from Novi Intelligence, but also want to just kind of highlight that the Novi products and the Novi tech suite that we use internally to do our own research, but also that subscribers and users of our tools and products have the ability to use to develop their own insights and findings in their workflows. So with that, we'll kind of get into it, and we'll start by just kind of setting the scene by showing kind of over the last 15 years the growth in wellhead gas production from U.S. horizontal production. You can see it's grown from roughly 13 BCF a day in 2010 all the way up to over 100 now. There's many different areas and regions that have kind of contributed to that growth. We're focusing here on the Marcellus and the Haynesville here. We're not gonna, within Appalachia, not really gonna dive into the Utica too much, but you can see that bottom blue wedge, the Marcellus, grew from basically nothing to the largest single supply source of gas right now today, growing 36% annually from 2010 to 2020. That growth has slowed as it has across all producing areas since 2020. That's a function of a number of things, infrastructure constraints, consolidation, capital discipline, um, and everything there. But you can still see that the two predominant gas basins, Marcellus, Haynesville, contribute about 42% of total U.S. supply currently. It's down from kind of a peak of about 50%. And the largest driver of that is their growth has kind of stalled while Permian associated gas continues to increase and take a little bit of market share. But still, the Haynesville and Marcellus are, critical supply sources and drivers for U.S. gas production. So what we will then do, just we'll dive into the Marcellus first, and then we'll follow on with the Haynesville. And so, speaking to the consolidation here, you can see it's kind of a maturing basin with more moderate growth over the past 5 years, and it's consolidated with basically the six public independents now accounting for about 78% of operated wellhead volumes. Um, and so we also put the PDP forecast here, which you can get from our data platform, which is Novi Insight Engine, and has all those well forecasts and going forward on a monthly basis. You can see we are modeling kind of about a 26% in aggregate first year PDP decline, um, you know, stepping down to about 18% in the second year. Now, the reason why we want to do this, one, to highlight some of the capabilities that are there from, Insight Engine, but also, show if you think that, by the thesis of growing demand and then absent some of the nuance of infrastructure constraints and everything like that, what are you going to do and what is necessary to fill that wedge to offset this PDP decline? And so, again, this is not like a robust supply forecast, but it's just to kind of set the scene and contextualize of the inventory that's necessary to kind of keep this flat to moderate growth. And so with that, we'll then dive into our inventory, and we'll start with horizontal wells that have been drilled already in the Marcellus. And you can see the activity is split between kind of the two core phase windows. The kind of dry gas, that's a little deeper up in the northeast, and the more liquids rich content that's in the southwest. Now, if you're familiar with Novi, you've seen our rock quality quartiling before. But for those of you that might not be, I'll just take a brief minute to kind of cover it again. And so, what we do with our analytics suite and then in our intelligence product and then in our well forecasting is with the machine learning models, we assess and analyze all the different factors and characteristics that can contribute to well performance. And there's too many to name right here, but we bucket them into kind of four broader categories. One is rock quality, which are the geologic characteristics. There's also spacing of how you're kind of staging your development, your completion design, and then prior pressure depletion. So what we are doing here is we develop the machine learning scores of all the geologic characteristics into a rock quality score, and then we quartile both wells that have already been drilled and remaining inventory and place them each into those four equal quartiles. And what we did specifically in the Marcellus on this one was because there's different phase windows and you have the entirely dry gas window up in the northeast, and then the more liquids rich production in the southwest. We did it on a mid-cycle pricing. We trained our model. It's still based on the productivity from the geologic characteristics, but trained it on a three-stream revenue at mid-cycle pricing, which for us was $75 oil, $20 NGL, and $3.50 gas. So you can see the liquids production and the revenue contribution from that is really, dictating that southwest production is the tier one, tier two. And all that's really saying is that from an economics perspective, at mid-cycle pricing for all streams, a liquids rich well is going to dictate and drive more revenue. Now, um, that's not to say, I want to be clear that these are not economic tiers because some of those dry gas wells up in the Northeast are extremely prolific and extremely economic. So this is just the methodology we used. We've had some um, conversations about it. There is um, just a way to break it up for the geologic characteristic, but this is not meant to be instructive of an economic tiering. But with the activity that's occurred to date, you can see that there's about 11,000 wells that have been drilled, and roughly half of those 11,000 are in tier one. So we move to that and we see our inventory forecasting for the rest of the basin. And you can see that we model a lot more remaining inventory and just abundant resource. And so if 11,000 wells drilled to date, and we're seeing potential for 27,000 additional locations. Um, about 43% of the tier one locations remain, but there's a lot of other proven locations out there. And you'll see, activity in central Pennsylvania where there's not been a lot of um, prior activity. If you think of that though, there's enough horizontal well production that informs our data-driven models, and it's since, showing us geologic characteristics that there are viable locations for sticks from a geologic perspective. It's agnostic of economics. I know there's some infrastructure constraints in the area and other cost constraints. Again, it's not an economic tiering right here, but viable locations and resource potential across that. So the message is just still a tremendous amount of a gas resource across the entirety of the Marcellus Shale. So what does that inventory mean in terms of inventory life and duration? So what we've done here is, if you see the left, you can kind of see activity level and how many wells in each period have been drilled in each tier, and then what that implies for remaining life. So the takeaway here you'll see is like, in recent years, activity levels and monthly wells have kind of trended down, and you see lower activity in 2024 and 2025. There is a little bit of a lag in 2025. Still about 60% of wells getting drilled are that tier one, tier two. Um, but then what we did was we took the 3-year average in terms of lateral feet tilled at each rock quality tier to determine how much remaining inventory in each tier is there in that cadence. So said another way, if you're looking at the chart on the right, we measure about 45 million lateral feet left for tier one rock. And kind of that 3-year average is about 3 million a year of tier one rock that's getting tilled. So just straight lining that down, that gets you to about 15-year inventory life on just tier one only at recent cadences. Um, the and then just longer duration at the other ones with less activity. We're at about average of about 6 million lateral feet per year across all tiers. So you can see overall just decades of inventory remaining. Um, So what does this mean in terms of the actual cost curve and the economics? And so still a lot of economic inventory remaining. I do want to point out right here that this is a wet gas break even that we are using. So the wet gas break even is basically, the a pre-processed unit of gas, or it's dry gas and NGL revenue after backing out the oil revenue. So while that number might look a little bit higher, it's including kind of NGL content. So it really is still a very economic wellhead wet gas level. Um, because then you see that median of about 350 for all of the inventory, and you're over 1,300 locations there. Keep in mind that there's only been roughly 1,100 drilled to date. So, you know, even, that amount plus some more of just below median price break even still remains. And certainly, there's the ability to achieve higher than that with, favorable NGL pricing and everything. So the message is just tons of economic resource remains. I will note we use a MPV 25 wellhead break even, half cycle. Uh, we in the intelligence product with the data download you get, we calculate everywhere from an NPV 10, 15, 20, 25. So you can kind of cut the data different ways. Um, but we like using the MPV 25 because that's probably a good threshold and a minimum requirement for like kind of a wellhead stick decision. Just for reference, though, kind of across the board, the MPV 10 is about 20% lower than the MPV 25. Um, so then we'll move a little bit on to the operators, and you can see kind of expand kind of dominates up in the Northeast. You have EQT, Range, Antero, others down in the Southwest, and then Seneca has this big block in that central PA area. So what does that mean in terms of actual identified lateral feet remaining? Like you can see, Seneca there has that, uncontested position in pretty undeveloped area across central PA, but then you expect to see, kind of EQT and expand um, kind of some of the most active players in the basin up there as well. You can see EQT has the higher kind of percentage of tier one and tier two. That's the positioning kind of in the Southwest and the three stream revenue tiering that we discussed relative to expand that's more weighted towards the Northeast dry. Um, Here's that same data kind of cut slightly different way. And again, that it's kind of showcasing how you can cut the data available from the Novi Intelligence inventory product there. So you still have on the primary vertical axis, you still have the lateral feet remaining, but then we just did it into MPV 25 tranche. And then again, you can see that, EQT and expand kind of lead the pack with the most absolute, footage with, um, low break evens. The red lines is implied inventory life based on operator specific kind of till cadence in 2025. So most of the public operators are the most active, all have at least 15 years or more of inventory remaining. A lot of the names that don't have that red line, it was inconsistent or not enough activity to kind of get a really truly representative inventory life. And then the last thing on the Marcellus, so what we do in the corporate service is we actually take that inventory view and we put it into a development schedule based on, our estimations of activity levels and the guidance that the companies are saying, and put that into action to do corporate level forecasts. So this is showing, our estimates of the average MPV 25 break even of inventory drilled each year for the four kind of Appalachian Basin companies that are currently in our coverage. Um, Again, it's a wet gas break even. So the message here is all of them, ample inventory over the next couple of years with low wet gas break evens. So it's going to continue to kind of generate the strong free cash flow that we've seen from these names in recent years. I'm running a little bit behind, so I'll try and pick up the pace and touch on the Haynesville real quick. But just the Marcellus takeaways, uh, the resources there. It's the other factors, takeaway constraints, things like that. But productivity, we didn't even really get into, but it's shown in our data platform is that it's remaining good. Um, Prior to pressure depletion isn't a huge problem. And even though there's decades of inventory, you're seeing operators do other things to continue to extend inventory life. There was a Hart article yesterday about EQT kind of experimenting with stack playing. We've heard similar things from other operators we've had conversations with. Um, Antero with the HG acquisition is kind of testing the boundaries and the limits of the play and looking to kind of extend that further. So lots of resource available. We'll do the same thing for the Haynesville, and I'll run through this real quick. Again, similar concentration, 73% of production from just six operators. Little bit steeper kind of base declines than the Marcellus. Um, the same thing with inventory. We've got about 7,500 wells drilled to date across both the Haynesville and the Bossier. Um, and what I would say there, just going to our inventory view, you can see most of it. You still have, ample tier one and tier two rock. A lot of it kind of more eastern, and you'll see on the slide here in a second that is a lot of expand acreage. Then same thing. What I would note is 2024 and even 2025 activity levels are down from recent highs. So, kind of using that, it maybe prolongs the inventory life, but we know there's the equivalent of over 10 BCF a day of incremental LNG capacity that'll be coming online along the Gulf Coast in the next 3 to 5 years. So the message is really probably while this inventory duration might be slightly inflated due to limited activity levels, operators probably have the capacity to ramp up, which can bring supply forward, but is also going to, shorten the duration a little bit. Um, and then again, uh, we do a dry gas break even in the Haynesville. And so that MPV 25 median break even is, 2.94. And then I think the average is just slightly above 3. But again, over 11,000 locations below the median versus, 7,500 that have been drilled to date. Um, Again, you can see kind of expand dominating this graph. I mean, the combination of Chesapeake and um, Southwestern really consolidated the core of the Haynesville to give them a dominant position. But when you go from this map and you look at all of the inventory, the other interesting thing here, besides Expand's position, which, stands out and is about almost 70% tier one and tier two rock, is some of the other large acreage holders like an Aethon or TG Natural Resources, GP Haynesville. Uh, they have all actually transacted with Japanese entities this year that are really looking to play in the complete LNG value chain and wanted to gain access to U.S. supply and U.S. feedstock for integrated LNG operations. Um, and then, again, you can see extended inventory lives based on activity levels. Obviously, Expand's going to the lead the field in terms of, the scale of low cost break even locations and just kind of reinforce maybe some differentiation that that platform has versus some of their other larger peers that are kind of Appalachian pure plays. Uh, I will note here, I should have known this, on the prior slide, but we see Comstock here, because there's a lot of interest in it. This is the kind of core traditional Haynesville only, so this does not include the Western Haynesville extension where there's a lot of exploration activity, and I know there's keen interest, but I want to be transparent that that's not included in these inventory estimates right now. But that'll be, Western Haynesville is in the inventory pipeline for the intelligence resource. So again, just a quick summary. There was a dip in Haynesville Bossier production in 2024 and a slight rebound in 2025, but to maybe meet the demand, probably need to see increased activity levels. The capacity is there. There is a pathway. Uh, there probably is less, midstream and transportation risk relative to other kind of supply basins. Obviously, we know the challenges in the Appalachia, but even other areas that could contribute associated gas are at a relative disadvantage compared to Haynesville. And then obviously the Japanese interest this past year buying Haynesville gas assets and inventory kind of underscores the role and the prominence it stands to play in kind of the global LNG trade and U.S. contribution to global demand growth. So that's it. We got a couple minutes left for some questions that may have come in.
Yeah, thank you, Robert. So, uh, thank you for listening to this interesting analysis. So, if anybody has questions, you can put it in the chat and we can start answering one by one. I think there was one from Jeremy Meyer about the rock tiers, and basically the question goes if these rock tiers that we have created um, are only for the core Marcellus, or are we adding emerging cells being researched by EQT, for example, like the Burkett?
So right now, it would be only the core Marcellus. For the most part, across kind of the whole play, we're treating the Marcellus as, a single pay zone. Up in the Northeast, we do give some credit for, both upper and lower Marcellus and opportunities for co-development. Um, but throughout majority of it, it's just a single pay zone where some of those other targets aren't getting really any credit or attribution. What I would say to that is I think our inventory mapping and our machine learning models are very, data driven. So as operators, whether it's EQT, I think Penn Energy is discussed it and everything, as they continue to test those concepts and we get more actual data, that's going to inform, future iterations of our machine learning model, and it'll allow us to make, more informed forecasts, lower, tighten the confidence interval on our machine learning forecasts. And so it's certainly opportunities to consider in future iterations. Our our play basin updates are done on a semi-annual basis, and so there'll always be changing. Sometimes we don't have any in the Marcellus in this iteration, but in other basins we do have, a category that we're calling, resource, which is maybe more perspective and maybe it's a broader confidence interval, but with continued de-risking has the opportunity to move more into that what you know we call PUD, which is like approved inventory, and we say that in just like approved viable stick, not necessarily like a 5-year SEC PUD reserve booking, but just, more confidence in that location.
Uh, for folks that we're almost on at the time, so one of the things is in the webinar chat, I put a URL where you can register and get some of this content for free. we will also be sending out some of the slides to all the attendees. And since we are at time, we are going to answer one more question, and the rest we will just follow up with an email to answer those. So the question is, in Haynesville, what rate can the Haynesville get by 2029? Can it expand by 10 BCF a day to meet the LNG demand?
So to that incremental LNG demand and that coming on, that the Haynesville on its own is not going to fulfill that entirely by itself. We haven't modeled it out as a, robust supply view with the, sequencing all of these inventory and coming online. Because if you go back here, we're looking at, let's call it roughly 14 BCF a day of current wellhead production from the Haynesville. So in the next 3 to 5 years, is the Haynesville going to go from 14 to 25 to exclusively supply all that LNG demand? No, it'll be contribution from multiple supply areas. Now, Haynesville has the opportunity to take up a fair chunk of that. And, I didn't use the exact terminology here in this one, but I think one of the taglines from when we published this Haynesville Basin report was sleepwalking into a shortage because activity kind of dipped in 24, 25 versus 23. To meet that LNG demand, we do see a need for a ramp up in Haynesville activity. But that incremental LNG demand, it'll come from a variety. It's come from Haynesville. It'll come from, additional Permian associated gas. It could come from Western Haynesville expansion, which isn't really considered in this analysis. And then among many others. So it kind of it's going to take all sources. But the Haynesville we do figure will be prominently involved in it.
Perfect. Thank you very much. If you have any additional questions, you can put them in the chat as we close this channel. I really want to thank everybody for your participation today on this webinar. If you think about any additional questions or would like to learn more about Robert, Novi, or the intelligence product, just send us an email and we will be happy to answer. You can also visit our website and then submit a question. We will jump to it and get to know you better. So with that, thank you very much, Robert. Thank you to everybody, and we'll be closing the session.
Thank you all very much for your attention.